Good morning. You're watching The Market right here in 18 hour with me, Aisha Faridi, Nikunj Dalmia, Avan Dabash in the studio. And for our markets, it was yet again a sideways session. Yes, we were choppy, but choppy in a narrow band. And we managed to close in at the session highs, although the session highs were only a flat tick for the index. Having said that, we continued to trade below the 50 DMA, both for the Nifty as well as the Nifty Bank, while FIIs continue to remain sellers for our market. At least the quantum has been reducing on a daily basis, and yesterday it was just 150 odd crore kind of sell figure. So it's minuscule in that sense as to what we have seen in the past 10 odd trading sessions. We've been recouping losses for IT, for financials, and they are leading the gains in the market. Having said that, over the last 3 trading sessions, the Nifty has managed to eke out a gain of nearly about 9/10%, and the Midcap index, that's seen a smarter and a stronger recovery with a 1.25% move. And I guess that's where the focus has shifted right now, right, Nikunj? Because the Nifty continues to trade listless. We're just hovering around in a very, very narrow range and a higher end of the previous range, but it's the Midcaps. That's where all the action is.
Actually, I was just thinking through it when I was making my notes in the morning. Just imagine the point we were discussing, that whatever could, in a sense, puzzle you, whatever could go wrong, has gone wrong this year. FIs have been net sellers, and they've been ruthless sellers. Adani fiasco, it really had a domino effect on the market sentiment per se. You had budget, earnings season, and yet Nifty has given you flat returns this year. Look at the YTD change in the Nifty, it's given you flat return. So my limited pointed with so much of news flow which was thrown at the market, Nifty has managed to hold on, which means the ability of the market to really stand up to the bad news, I think, is quite amazing. So something now really dire has to happen for Nifty to break down, and that is something which is giving confidence to the trader that, okay, Nifty has survived the storm, the news flow which was in and around, both at the global level and at a local level. So if benchmark indices have managed to hold on and they've exhibited resilience, is it time now to navigate towards mid and small cap stocks? And that's typically how markets work. First, markets, when they realize that benchmark indices are in a range and they're trading with a positive bias, then the confidence to trade into mid and small cap stocks is there. And this earnings season, I guess, according to me, has been the differentiating earnings season, where a lot of mid-cap companies, after 2-3 quarters of painful commodity margin compression, they are coming back, and demand actually is coming back on the track for them. So I think we are at that point now, and the screen is also telling you that the underperformance in mid and small cap stocks will improve, and the resilience in the Nifty is something which markets are now saluting and really excited about.
Yep, that's exactly what we've witnessed, and the returns really speaking for themselves for the indices. But overnight, you had the stocks in US closing lower, all 3 major indices as well hitting their session lows in the final hours of trading, and they're on track to end the week with losses as well. Asia across the board seems a little bit mixed. You had the China inflation data that came out, and the SGX Nifty quiet with a negative bias. But Nikunj, as Aisha was alluding to earlier, in terms of the net selling of FIIs, yes, we've been thrown with that, but at least going by the kind of data that we have, the net sell figure is abating.
And if this trend continues, Avan, this is just going to be a spring in the stride for the bulls. It will force the short sellers to cover their positions, and it will be a very, it really could really change the market momentum in the short to medium term. Now, it's not that flows have moved out of emerging markets this year. It's just that India has been, the other emerging markets have been net recipient of inflows, and Indian markets, unfortunately, have been on the side of net outflows. Money is moving into China, and after years and years of underperformance, Chinese stock markets are getting inflows because they've underperformed, they're cheap. But in the last couple of days, the Chinese markets are getting slightly rusty, and the realization that in India, inflation is speaking out, growth is back, budget has been strong, and the Adani fiasco has not had a collateral damage on the financial system per se, are factors which have made the market look attractive. So I will not be surprised that once the Chinese sugar rush is over, or once the sugar rush of FI flows into China that is over, Indian markets will not get outflows and we may get positive inflows as well. Because markets are no longer that stretched and expensive, and all the chaos and confusion which has happened in the month of Jan and early Feb, at least in individual stocks because of Adani fiasco or because of earnings or because of FI flows, is now making individual stocks look far more attractive. So while you may argue about, okay, Nifty is done nothing, momentum nahi hai, we can argue about it, but I guess this kind of a churn in the market always gives you opportunity to buy, and that is where we are. Remember mythology, Samudra Manthan. The churn which has happened in the market, and that is what we need to focus on.
Yeah. And the churn is also happening in the new age tech names, isn't it? I was just looking at Zomato's Q3 numbers. The numbers, of course, came in well into the wee hours of the evening. And that's something that we're going to first pick up on today. Just looking at the numbers, the adjusted revenue has come in lower by about 1%. The adjusted EBITDA loss stands at 265 crore rupees versus a loss in the previous quarter of 192 crore rupees. And the loss on a total basis or a net basis has come in at 346.6 crore rupees versus a loss of 251 crore rupees on a quarter-on-quarter basis. Now, the management commentary, that really is where one can really derive hints from. You have Dipinder Goyal saying that Zomato has hit a milestone in January 2023, becoming EBITDA positive ex-Blinkit. Says we're on track with our path to profitability by second quarter of FY24. Also saying that exciting things are unfolding. Zomato Gold already has 900,000 plus members in less than a month, and that he believes Zomato every day, our home-style cooked food offering, will be equally disruptive. Saying I'm really excited about the potential these hold. Now, operationally, Nikunj, the numbers are in line with what the market was anticipating. But the management wants you to analyze these numbers ex-Blinkit while it's very much a core part of the portfolio.
No, you cannot do that. Look, Blinkit is part of the portfolio. It's an acquisition
so why
by
would
choice.
You look at ex-Blinkit?
Yeah, because see, markets want to look at two things here. I mean, nobody anticipated that the Blinkit acquisition is going to turn around. Yeah. The main core business for Zomato is the food delivery business. They were losing money even in this business when they went public. So directionally, they are reducing the losses there. The business has turned profitable. You throw in the Blinkit element, and I think that in a sense is something which is going to change the equation, because Blinkit is not going to turn profitable in the near term. The problem, I think, for Zomato is that this is a high growth business. And now they've come out and have said that, look, our business is slowing down. Hello. You are a high growth company. A high growth company cannot slow down. Is the food delivery business slowing down? Have they really saturated the 6 metros? You think about it, in the major metros, the Zomato or the food delivery operations are just there everywhere. So these cities are penetrated. They'll have to grow beyond these cities, and the base effect is now kicking in. If the business is slowing down, then that is bad news for Zomato. Operationally, you can argue and say the food delivery business is moving in the right direction, but Blinkit acquisition will take some time. If the demand comes back for Zomato, then FY24 would be a different year, because they already have defined the path to profitability, and on that, high demand will give you operating leverage. Now the stock. The stock has gone from 45 rupees to 55 rupees. The stock has gone up the minute Paytm numbers have moved out. Markets were expecting good set of numbers. It was one of the top traded stock in last couple of days. So I will not be surprised that we may not see the reaction, the kind of reaction what we've seen with Paytm. Now the monitorable for Zomato is going to be the business growth rather than path to profitability, because suddenly everybody would say, oh my God, the business is slowing down. And if it slows down further, then there is a problem.
Yeah, in terms of the kind of commentary as of now that's been given by the management, they're saying profitability with growth in food and hyper pure over profitability. How have brokerages reacted? Just a quick look. Morgan Stanley overweight, target price at about 82. Cities got a buy rating with a 76 rupee target price, and Jefferies as well, a buy rating. They've got a target price at about 100, saying that the company is continuing to show an urgency to reduce losses. All right, we'll have to wait and watch at 9:15 as to how these stocks open for trade. But in the meantime, let's hear it out from Market Voices. Rahul Chadda, Chief Investment Officer at Mirae Asset Global Investment. He is invested in a lot of these fintech stocks, the likes of Nykaa and Zomato. Why does he like them? Let's listen in.
So we've liked some of these new age IPOs. I think Zomato and Nykaa was where we kind of initiated exposure when the stocks were down 50-60% from highs. Our point was, look, with good managements, business models with strong headrooms for growth, some of these valuations were reasonable, or some of the pessimism about growth was baked in when the stocks were down 60-70% from their highs. PTM, honestly, I've got to do more work over there. And why I say more work is because there's a credible bunch of peer set, which is the private sector banks, which is available. And those private sector banks for us are kind of a fintech giants of India, which are available a fraction of value of these new age fintech companies. A lot of these new age fintech companies are giving the loans, growing fast. Some of these loans are again in the underpenetrated categories, and you don't have much of a credit history over there. So it's easy to get excited over there, but one doesn't know what happens when the cycle turns bad. So which is why I'd rather play that through the established private sector banks where one has 10, 15, 20-year history of credit cycles. And if one wants to play at the new age internet exposure, look at the likes of Zomato, Nykaa for that matter. I think the structural theme continues to be financials. They're a best play on improving economy. Industrials are interesting here because, look, for the first time, we've seen capex pick up. The government capex continues to be fairly high at 3.5% of GDP. It's moved from 2%. The spends are high. If the government capex continues to be this good and the economy recovers, private sector capex is going to pick up. So financials and industrials, more medium-term theme. And from a 3-4 quarter, autos look interesting.
To our chartists and find out what the trade setup for this Friday is looking like. Kunal Naresh in the house as always. Kunal, just such a listless Nifty. I don't know if one should be happy about it, but can it move either this way or that?
Yeah, I think it's moving this way and that way, but no major direction for the indices. I think that's the tone for the market since last so many days, as well as over the last 1 or 2 months. The ranges keeps on expanding and contracting for the indices, but no major trend which has been emerged on the index. And I would probably expect that a similar situation could happen this time around as well. There is absolutely no change in terms of the open interest. For example, even on a day like yesterday, there was just hardly 1.5% reduction of open interest on the Nifty, and 0.5% addition on the Bank Nifty open interest for the futures. That itself tells you that the trader participation, the interest, the propensity to carry forward open interest as well as volumes into the indices is very, very low. And in this kind of an environment, it's bound to be that the indices remain to a range. 17,700 remains to be the lower end of this contracted range, and 18,000 approximately is the higher end of the range.
So, Naresh, if I do a sound cloud, not a word cloud, of Kunal's answer today, in a 1-minute answer, he's used the word range at least 10 or 11 times. Is that the simple sum and summary of benchmark indices? Range, 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 range bound. I'll make you range bound.
Exactly, it's a range and at the
Define
same
the
place.
Nifty for me without using the word range now, Naresh. You cannot use the word range. Your market
Going
outlook on the
nowhere.
Nifty, just one word answer, going nowhere. Kunal,
Yeah.
simple, no analysis, going nowhere.
That's why I said this way and that way, but not leading to any kind of a conclusion.
But think about it, Kunal. Just look at the news flow. Adani, budget, FI selling, uptick in crude. And yet Nifty has been in a range. Imagine if I would have made a case.
Not using the word.
Yeah. No, I'm saying imagine if I would have, even I'm using the word range, but that's the way it is. But if I would have made a case that there would have been an Adani fiasco, there would have been pent-up FI selling, crude would have jumped from $75, $76 to $85, $86, and China would have started outperforming, then predict the Nifty. And then we would have talked about levels of 16,000 or sub 16,000. But the fact that Nifty is stuck in a range, it just tells you, Naresh, the underperformance, the resilience there.
Absolutely. So it's a resilient market in terms of not falling the way it would have been expected given all the things which are happening around it. And the problem is the resilience continues to be a problem because we are not going anywhere. There are not many opportunities to actually capitalize. So, for example, if you look at it, the Adani ports and Adani enterprise impact was say 1% on the Nifty, and we are still at 17,800, 17,900 zones. And if you remove that, we are at 18,000. So we've been at 18,000 roughly for the last 2.5 months. If you remove out whatever has been the up and down tick, So the support level of 17,800, which was there before the Adani fiasco. So overall, we have not gone anywhere. And the funny part is, if you go back to say October of 2022, you go back to September of 2022 or March 22, or go back to say January 22, we were always around that 18,000 mark. So you could randomly pick up a date over the last 1.5 years and you'll say you were around 18,000. So it's been 1 year. We've gone through that phase of interim corrections, whether it was Russia, Ukraine, whether it was global. We've gone down and we have again flipped back to 18,000. So for now, we wait for that say markets to give us that indication that further whether it wants to make a move or stay here only.
All right, let's find out some top recommendations then and what exactly it is that our chartists are picking out this Friday morning. So, Kunal, yesterday you were talking about a little bit of outperformance within the broader markets. What's the strategy today now when picking out stocks?
So I'll still stick to broader market picks, but then I think I'm just adding to one of the other favorites which I've been highlighting over the last couple of days. That's ICICI Bank. That stock is again looking attractive. So again, the stock consolidating in a range of 15 points, approximately 855 plus or minus 15 odd points is the range for ICICI Bank. But I believe that after yesterday's price action move, the stock can probably head towards a breakout for itself. So 888 is the target for ICICI Bank, stop loss at 850. I'm adding on to IRCTC. That's an interesting name which has popped up on the charts, breaking out of that 635 barrier on the short-term basis, also crossing back about double bottom formation on the daily chart. So that's a buy, 700 as a target, stop loss at 622.
Okay, and Naresh, what are stocks on your radar? I know Kunal described range for even ICICI Bank, but that aside.
So focusing on the large caps, which have been showing a little bit of resilience in the last couple of sessions. So first is the buy on Reliance Industries, which is closer to that 2300 mark, which has been a support level for the last almost 2 years. It topped out at September 2020 around 2300, and over all the corrections over the last 1 year, whether it was Russia, Ukraine, or the windfall tax, it has made a bottom around that 2300 plus minus 50 band. It started showing a reversal sign, so taking it as a risk reward trade, stop loss at 2290 and a target price of 2450. Second is the buy on L&T, which continues to be one of the leaders in the capital goods space. Glass gave a breakout about 2050, 2080 levels and is holding on to that level in the corrections. So expecting this to again slowly pull back towards the new all-time highs. So stop loss at 2080 and a target price of 2250.
Right, there you have it. That's what our chartists are betting on. It's a mix of large and mid caps in their portfolio. Let's take a very short break. Stay with us for lots more market analysis and all the stocks and news.
Okay, back with the market right here, Etina. Let's just bring up what the SGX Nifty is suggesting, and a downtick of nearly about 0.5% after what turned out to be a ranged session in yesterday's trade. Just very quickly, want to check in on what the US market handover was and what Asia is up to. While US was roughly about 1% downtick across the board for the Dow, the S&P as well as the Nasdaq, Asia this morning is pretty much mirroring the same sentiment. While Japan is holding up 0.5%, not quite the case for Korea, for Hong Kong, which is sharply lower, 1.25% lower as we speak right now. And China as well is marginally soft as we speak, and so is the SGX Nifty down 0.5%. But getting back to stocks back home and missing street estimates, Zomato's loss has only widened in the third quarter. The management is citing weak demand environment for the food delivery business, but the company goes adjusted EBITDA break even in the month of January. Vinny is here to tell us all about how to really read the numbers. Vinny?
So, I just want to start with overall, yes, the commentary has been quite bullish for Zomato in terms of what the management has given. But in terms of the numbers, food delivery business, especially, which is the core food delivery business, that has seen a decline in terms of the adjusted revenue by 1%. Now, overall, when you look at it, the adjusted revenue has seen a growth coming in at around 12% growth. But food delivery business has seen a decline. Losses overall have widened for the company. The adjusted EBITDA loss, that has also further widened. Adjusted EBITDA loss is coming in at 265 crores. Now, let me just get specific to food delivery, especially. Yes, they had broken even in terms of their adjusted EBITDA last quarter itself. This time around, now the adjusted EBITDA is coming in at 23 crores versus 2 crores last quarter. A gross order value, that is muted. That was expected to be muted as well. So, 0.7% growth on a quarter-on-quarter basis in terms of the gross order values for the company. Quick commerce, that's the Blinkit business. That seems to have seen the revenue a growth coming in, orders have seen a growth coming in as well, but average order value, that's seeing a reduction coming in. So that is a factor we are keeping an eye out on. Now the management has especially highlighted that they were seeing a slowdown coming in the food delivery business since October, that's post the festive season, and overall that is why the decline was there in the adjusted revenue, because the order volumes reduced. People have started stepping out now, so the orders will see maybe a reduction, and that is a factor that we are keeping an eye out on going forward as well. So yes, keep an eye out on that, because the management commentary said that they are confident of achieving that adjusted EBITDA by Q2 FY24. Jan, they are already broken even, excluding Blinkit, so that's a factor to keep an eye out on. But yes, when you look at the brokerage notes, Jefferies is maintaining a buy, target price of 100 rupees per share. Morgan Stanley maintaining an overweight rating with a target price of 82 rupees per share. All in all, a slight bit of a miss coming in, but Jefferies is quite positive on Zomato.
All right. Thanks very much, Vinny, for breaking it down for us. We'll also be getting on board an analyst in just a bit to analyze the numbers in greater detail for Zomato and how investors should really be looking at it. But the other big news maker is LIC, posting a multifold growth in their consolidated net profit this quarter. The net premium income rose 14% on a yearly basis. Let's take it across to Somit. He joins in with all the number crunching. He'll be joining in in just a bit from now. But in the meantime, let me chat stocks with our charters then and find out what the outlook is. And Kunal, let's get in your take then. Just talk a little bit about some of the large cap stocks. You've been pretty bullish on a Bajaj Finserv, if I'm not mistaken, right? So what's the outlook given the fact that it has been performing at about 1400?
Yeah, both Bajaj Finance, Finserv, they've been doing pretty well. And, there was a chart pattern which was very, very rare to find to these kind of names, that is triple divergence, where the stocks were making 3 consecutive lows on price basis over the last 1 month. And on all of those 3 occasions, the indicators had started to get into a formation of a higher bottom for themselves. Now, that's typically a point where the stock manages to absorb as much of selling pressure and then gets into a process of a bounce. Now, initially the bounce itself for Bajaj Finance and Finserv have been more than 10%. So, for example, for Bajaj Finance, the stock bottomed out closer to 5,800, and yesterday I think it touched a level of 6450 levels. And same is the case with Bajaj Finserv as well in terms of percentage gains. This could probably be an indication that these stocks have now come out of a major bottom formation process. That 5,800 mark for Bajaj Finance and probably similar levels for Bajaj Finserv around the 1250 odd levels could be termed as major bottoms, and these stocks can now build on from the gains which they've established over the last 1 to 2 weeks.
Okay, let me take it across to Sandeep Sabharwal and find out what his market opinion is. Sandeep, hi, morning. The talk this morning is all around Zomato, right? I mean, the management is saying review us, but review us ex Blinkit. But why would you do that, considering it's very much part of the business? How have you dissected the numbers?
Yeah, so the job of the management is to be bullish, and the job of all of us is to analyze the results as they come and based on whatever we see around us and how we see the company performing. Now, obviously, the Blinkit acquisition was a hasty one, and that's hurting the company now. If that had not happened, obviously, the company could have been in a better state. So, and there's no case for anyone to look at the company X of Blinkit because it's finally a part of the company. Now, the core food business, so like we saw in the case of Paytm, the core payments business has been slowing down. And in the case of Zomato, the core food delivery business slowdown has been even more drastic. So many of these companies, as the growth slows down, will face issues. And I think those issues will get more apparent going forward. So I think just coming out and making a statement after reporting a higher loss that we will actually turn profitable makes no sense. So I think it can excite the analysts, but as investors, we have to be more dispassionate.
That's one part of the story, right? The other part of the story is what's happening with the stocks. After getting thrashed out in the last 1 week, or actually ever since Paytm's numbers, you are seeing a big turnaround in these names. The last 4 trading sessions, you've seen the stocks jump up almost about 35% in a few odd cases. What do you do if you want to invest in these names? Is it still a no-no?
So I think for people who were stuck somehow and you get a big up move, and then I think it's more opportunity to exit than get into these names, because for loss-making companies, historically, it's been proven that in a rising interest rate environment, it's tough for them to actually perform. So I think uh, so I would think that any big rally should be used for people to actually exit, or if you have a or something like in a Zomato, maybe if you have a 3-5 year horizon, you might not exit and see if the things actually improve. But the results give actually no confidence to come in and buy. It's just that it's got like from being very heavily overowned, now it's not so owned. And to that extent, if just some people get excited based on management commentary, there could be an up move. But it will be very tough for it to sustain.
All right, stay with us. Lots more to talk about. Let's quickly hear it out from Chakri Lokpriya, his top fundamental stock pick.
I think in that space, clearly Apollo Hospital is still the leader. Still looks good. Narayana also looks good. All the elective surgeries are coming back. The occupancies are moving up. And now is the time when, and they're also expanding, all these companies, and they're also expanding into the tier 2, tier 3. And when you look at their operations, what they're doing into this tier 2, basically now they're trying to bring healthcare to where in the past they would, from people from tier 2 would travel to tier 1 for an operation. Now they're trying to reduce that inconvenience for the consumer and or rather the patient. So these stocks have also corrected. If you have, and given their annuity in their cash flow, it's a very predictable cash flow. People fall sick, get admitted, and therefore they can sustain a higher multiple and EV/EBITDA multiple, and current levels look good.
Sandeep, to the other underperformer, I don't know if you've analyzed the numbers or not. LIC, the profit has zoomed multifold this time around. The premium income as well has come in higher. What do you do with LIC?
Yeah, the results of insurance companies are very difficult to decipher. Actually, I find it very tough to analyze them because of so many moving pieces. But clearly, LIC was one of the companies who will get the most hit because of the measures which were announced in the budget, because I think LIC policies are sort of the most missold. So there's no big story in LIC per se. So I wouldn't. So I'm not investing at this stage.
Fair enough. That's the view coming in on LIC not investing at this stage. All right, let's take it across then to my colleague Anisha, who joins in to break down the numbers for us and walk us through the critical financials. Anisha?
Well, yes, LIC has reported a decent set of numbers. It's a tad bit mixed, but let me start with the key internals. As far as the profitability is concerned, it's looking quite healthy at around 6,300 odd crores. But remember, there was a one-time investment income impact on that. But separately, if you strip that away and look at the internals, they also look quite healthy. The operating cost of the company, which has been a bit of a concern for the investors, that has been coming down. So the OPEX declined by 8.5% on a year-on-year basis, and now the OPEX ratio is at 6.7%, which is best in the industry. The total expense ratio has also come down to around 12.3%. Even if you look at the APE growth, or the average premium equivalent growth, that's coming at 16.5%, and that has been led both by the single premium as well as the first year premium. Even the quality is quite better. So persistency ratio, which simply put for a layman means that these are the policies wherein you get a consistent premium coming in and renewals coming in, that ratio has also improved. For the 13 month, it's coming at 71%, and for 61 month, it's coming at 56%. The other thing that the street has been watching out for is how the share of the non-par is going to move for the company. The management has been saying that they're looking at increasing the non-par revenue, and that is what exactly has panned out. It now stands at 9.5% versus around 7.5% that it was there in the last quarter. What is disappointing? Well, the value of new business margin is a tad bit disappointing because that came in at 1,800 crores. It was lower by almost 21% on a sequential basis. And even if you compare with the expectations, the street was working with a number of around 2,100, 2,200 crore there. So a bit of a disappointment coming in there. But the other internals are looking healthy. So my guess is the earnings should be taken well by the street.
You know, my view on LIC is simple. Till the time the Adani fiasco is not going to settle, a stock like LIC will underperform. Now, we may argue back and say that, okay, the loss in the balance sheet of LIC is not there because the book value or the price at which they invested in Adani group of stocks, the current market price is higher than that. But ultimately, for a company like LIC, there is something called mark to market, which is how do you book your treasury, investments. And Adani investments for the quarter gone by, which is the current quarter, they need to be booked differently. What we are discussing right now are numbers for Adani for the last quarter, December quarter. The fiasco in Adani group of stocks have happened in this quarter. Now that's the view from LIC chairman on Adani. They have not sold out of Adani stocks. They're monitoring them. They're not looking at investing more in them. And on the balance sheet of LIC, there is no loss to principal, but mark to market is something which is going to be in big overhang. Sandeep, that's the point, right? I mean, till the time Adani stocks do not settle, LIC overhang will be there. It could be psychological, but this overhang is real.
Yeah, the overhang is real, and it's more also due to having a sort of, I would say, ostrich-like approach of not recognizing incoming information and just sticking to what information was available earlier and not taking any decision. But that's fine. So I think that's their call, because it is a big proportion of their overall equity exposure. If I'm not wrong, as per whatever data I read in the papers a few days back, it was 8% of their total equity exposure, although just less than 1% of the total exposure. So it's not small, and it would have hurt their overall equity returns significantly. But that said, I think overall also, I think post listing, its performance and the union budget provisions as it is, the attractiveness of LIC is not very great.
At some of the other numbers, good numbers from a Rites, good numbers from a Sula Vineyards, Alembic as well has posted quite a phenomenal quarter gone by. Nidlon as well has seen a very good quarter. IOB has seen a jump up in their NII by about almost 44.5%. In fact, the asset quality as well has seen a marked improvement, and the NIMs have come in at 3.25% versus 2.4 on a year-on-year basis. IOB will just come up for you on your screens next. That's another earnings reaction that we're going to await today. There's also, of course, IOB, Indian Overseas Bank, not IRB Infra. That stock will just come off you on your screens. But HPCL is the other one as well, which has posted some good set of numbers. The Q3 numbers are above the market estimates. HPCL and the EBITDA as well has come in at about 1,277 crore rupees versus an EBITDA loss in the previous quarter. So HPCL as well, a marked turnaround there in this particular quarter. There's of course Lupin as well, and the US sales are actually at a 3-quarter high. The revenue and margins have come in line with estimates. So good set of numbers from Lupin as well. And then of course Oro Pharma as well. Overall the numbers look above estimates. But that's the takeaway really on some of these earnings. Can we take it across to Kunal? Across to Ahvan and Nikunj then for the stocks on their radar. Ahvan?
Yep, so let's find out what we're talking about in today's session on stocks on the editor's radar. Well, we'll be discussing today United Breweries as well as Voltas. So just bring up those graphics for you when it comes to United Breweries as well. There's been a multi-year low gross margin that has driven the earnings miss this time around, Nikunj. So how really should the street be looking at this, given that the revenue growth as well has been pretty flat?
I'm surprised. I'm surprised that for a company which ultimately represents the liquor sector and has a brand and has some of the most powerful brands like Kingfisher, they've had no pricing power. They've taken price hike, but the raw material price impact, the intensity was so high that they were not able to negotiate it. Margins in a category which is growing have plummeted despite their market leadership position. And if a brand is not able to increase pricing in line with the raw material impact, that just tells you that somewhere there is competition or fear that they will lose market share if they increase prices. So the stock will get into downgrade. Unlike a lot of other FMCG companies which have come out with decent set of numbers, their margin challenges are getting down. I guess United Breweries, at least for the quarter gone by, when commodity prices were generally declining, they've reported poor set of numbers. So the stock will remain an underperformer. It will warrant a lot of brokerages who track it to come out and slash the estimates for FY24 now.
Okay, so lack of pricing power is really going to be one of the key stumbling blocks when it comes to United Breweries down the line. Watch out for that stock, but also keep on your radar Voltas. We're dissecting the numbers as the Q3 operating results. This too was coming in as a big miss as to what the street was expecting. You did see that contraction in the EBITDA, clearly missing what the street had penciled in, Nikunj.
Yeah, again, these numbers, I wouldn't say they're howler, but they've disappointed. They've disappointed on all the front. First, margins. You can argue back and say, okay, margin were under pressure largely because of the commodity prices. But the demand for their electromechanical project and the engineering product, that's also taken a knock. Now, we are talking about a capex cycle starting. Then they start a group company. Why is they have not been able to come and command some degree of growth, at least in their non-cooling business? So there were three businesses. One, which is, we all know that, Voltas Kaisi.
Yeah.
Second is the electromechanical business, which is more like a cyclical business, and the engineering product service business, which is more like a consultancy and a service business. Both these businesses are not growing for them. So for me, that I think is a problem. While CLSA is still maintaining an outperform, I would argue back and say that the stock is trading at something like 35, 36 times 1 year forward. And with these numbers, earnings upgrade are unlikely to kick in. If you're in for a warm and a very tough summer, the unitary business may make a comeback. But the aggregate picture for me, considering what the potential of the company is versus what they've delivered, especially in their non-cooling businesses, in my book, that's a disappointment.
Okay, Voltas, there you have it, and as well as United Breweries, Aisha. Let's find out what our market experts as well make of these stocks.
Banks and more banks. Dipan Mehta, here's what he told us about what in specific he likes within banks.
The merger, I think, has been in the works, but it's just getting delayed. But there's no denying the fact that the underlying fundamentals of IDFC First Bank have significantly improved. Do a quick comparison, I think it is a winner on all fronts, whether it is deposit growth rate, CASA, net interest margin, profit growth, improvement in the balance sheet quality. I think across the board, when you compare IDFC First to its peer group, it's a clear winner. The stock is at a reasonable valuation, very aggressive management. And I think that amongst the banking stocks, it is our top pick, usual disclosure that we and our clients are invested, and should clearly outperform the bank Nifty and some of the other larger private sector banks and maybe a few of the PSU banks as well. So that is one stock that we're very positive on.
Now, Karan, there was excitement in the Zomato stock post the Paytm numbers that what Paytm indicated in terms of a path to profitability, Zomato will do the same. In your book, if I look at the Zomato numbers, are they good, bad, in line?
I think Zomato numbers are in line. I would not say that they are excellent, but definitely they're in line. Basically, if you look at what they've been guiding, the path to profitability in the food delivery segment, they're on the right track as we speak. If you look at the contribution margins, they're at 5.1%. And this is even higher than the peak of the pandemic levels, which was around 4.5%. So if you look at what has happened this quarter is that clearly in the last 2-3 quarters, we are seeing trends wherein they are trying to focus, less in terms of growth and focus more in terms of profitability. They are trying to actually mine the customers which are loyal in nature, kind of increase frequency. So these are two big drivers, revenue growth being in the range of 25-30% and profitability increasing consistently on a Q-on-Q basis. So I think these are two multiples for the food delivery business. And you are basically trying to exit markets where you are making losses. So there's a clear focus in terms of driving efficiency, reducing delivery charges, exiting loss-making markets. So that's a good thing, for the company.
So is Zomato a buy or a hold according to you?
So I think at these valuations, Zomato, could be a, kind of a compelling buy, because if you look at the stock price, I think last 3 months it's come down by close to 25-30%. And if you look at it in terms of EV/EBITDA valuations, just on a forward basis, and assuming that they achieve this, 4 to 5% of EBITDA as a percentage of GOV, what they've been guiding for over the next 2 to 3 years, the stock is currently trading at somewhere around 25 to 28 times EV/EBITDA for the food business. So there is value buying here, as far as the standalone food delivery business is concerned. But one really has to look at how Blinkit shapes up, because that is very important. So if you look at the company today, I mean, close to 85% of the losses are coming from the Blinkit business. And one does not know the unit economics of this business, how it is going to pan out. I mean, the AOVs are high, the frequency is high, the order growth is fine today. But once Blinkit scales up beyond, 3 or 4 cities, or maybe goes more in terms of the tier 2 and tier 3 towns, will this economic sustain and where will the losses be? So if you include the losses of Blinkit, I think the company is trading at valuations of close to 35, 40 times EV EBITDA, which is a fair valuation. But the core food delivery business, I think, is a value proposition.
Really appreciate your time. And thank you so very much for joining us. There are two stocks I want to discuss extensively with Sandeep Sabharwal. There's one stock which I know he tracks. Sandeep and me have been good friends for how many years, Sandeep, now? I think 2004 or 5 we've been friends, almost 20 years now.
Yeah, I think 4 or 5 years.
Yes, it's been a while I've known him. And it's been a while I know that he's been tracking Voltas. Sandeep, it's a Tata Group company. And it's a Tata Group company which has not really structurally surprised anybody. I look at the business, there is engineering services which is not growing. There's electromechanical which is not growing. While India is going through a capex boom, here you've got a Tata Group of company, nicely positioned, great brand, unique talent, but they've not capitalized.
Yeah, the main issue I've seen over the years is I think they bid for projects, then they realize that they bid wrong, and then they need to take extraordinary losses because of that. So I think that's been a feature of their results. So you open up last 10, 15-year results, I think there'll be 5, 6 incidents when that would have happened. And I think that's what has been the biggest issue with Voltas. In fact, yesterday only I was comparing performance of Blue Star with Voltas over the last 1 year. Blue Star is up 30%. Company has done extraordinarily well, both operationally also. And Voltas is actually down 30% over the last 1 year. So that reflects, I think, some confused thinking in the management in the past. But I think now they are getting things in hand. See, the core unitary cooling business has no issue. It's just that the market was bad, they did badly. They are the market leaders, and if last 2 years sales have been bad, the probability that this summer sales will be good is very high. So I think to that extent out there, they should do well. The other thing which so although the conference call is still to happen, but what I saw in the result release was that they have won big orders in the electromechanical projects business, where the order book has moved up sharply to around 7,500 crores from 5,400 crores. So I think that's a positive, and if that comes in with improved margins, it could help the company turn around. The stock is down a lot, and if because of these results, etc., if it cools off further, I would be interested in actually buying the stock. So I'm looking at it from a perspective of looking to buy rather than turning negative now when the stock has fallen so much, although we don't own it at this point of time.
Blue Star and Volta, just a comparison here. Now, in markets, there is no point in doing these backward comparison because markets will always vote for rate of change. But if you have to establish that what kind of massive underperformance Voltas has had, I think you'll have to compare it with Blue Star. Even though it's not a like-to-like comparison, because Blue Star does not have the electromechanical business and the consulting business. But yes, let's compare that just to establish that point here. My producer will just fire the graphic. We've told you about Voltas. That's Voltas and Blue Star for you. Voltas down 30%, Blue Star up 30%. Now imagine the difference. It's almost one has gone down, other has gone up. So the difference, I think, is very, very large. And if I amplify Voltas and Blue Star on a 5-year basis, 1 year could be, this has gone right for the Blue Star and that has gone wrong for Voltas. But 5 year, I think, is a reasonable time frame to compare any business, considering the durability of the business. Blue Star is such a phenomenal wealth creator, guys. We don't realize about it. That's Voltas for you. On a 5-year basis also, Blue Star has given excellent returns. Kunal, do you want to take a guess what Blue Star has done in 10 years?
So yeah, I think from 100 rupees, the stock is at 1300, I think in the last 10 years.
We don't talk about it. I mean, here's a AC company, not the most powerful brand. How many people you know about Blue Star in the house? Everybody's talking about the Koreans and the Voltas and the other ones. Here's a company which has grown without raising capital. In last 10 years, the stock is up 7x. Isn't that phenomenal? Okay, I'm going to switch gears and go to Nuresh again. And Nuresh, as we walk into trade this morning, SGX is down 100 points. Nifty is in a range. Every reason to believe that we are in for another range-bound Friday.
So what we've seen is in the range-bound moves over the last few days is on a sharp gap down of 150 points or odd closer to that, we start seeing some support. So if I were to wait for a trade, the trade would be that if we go closer to that 17,750, 17,800 band for the Nifty on the spot basis, that is the point of time I would like to take a trade for a bounce back. And if it doesn't do that much of a gap down, we are just again waiting for say some stock specific trades, but anywhere closer to that 17,750, 800 mark, that is the price point I would be looking out for an intraday buy.
Meantime, Sandeep, wanted to get in your thoughts as well as to what the outlook is when it comes to Aurobindo Pharma. Sales have risen, margins have been a bit of a mix this time around, although the US growth has been quite steady, and Lupin revenues have been a beat, but profits at 157 are much lower on a year-on-year basis. Your takeaways?
So Aurobindo, I'll give a miss because I don't know what happens in that company and how their balance sheet moves, and I've commented on it across the years that it's very tough to understand that company. But Lupin is something where we have been waiting for a turnaround for a very long period of time. We took some small exposure. Actually, the stock went down 10% from there. So I've been waiting for so we've been waiting for several quarters for the turnaround to happen. It's not been happening. But I think these results reflect a clear turnaround. So I would think that as it could become a contrarian bet in the pharma sector because it's a large established company. It had its issues, and if it's coming out of its issues, then I think the stock could perform because it's become absolutely underowned. No fund owns the stock right now.
Results reflect that the company is turning around. What is that is catching your attention in these numbers, Sandeep?
I think it's the uptick in margins have moved up sharply, and although the sales growth also is above expectation, but it will take time for the pace to pick up. But in terms of operating margins, the profitability is picked up, and I think that will help the company perform.
Another sector which we've discussed extensively with Sandeep Sarwal are some of the tire stocks. Guess what? Rubber prices are inching higher. Crude prices have gone higher. Is that trade, that big trade, Sandeep, which made a lot of money for you and your clients and your subscribers in 2022, go long Apollo, go long CET, go long MRF, is that trade over?
No, in fact, top hold is Apollo right now, and I would think that the company will continue to do well because of various factors. One, they have cut down on capex significantly, so next 2 years we'll see deleveraging in the balance sheet. Secondly, as per the company conference call, their raw material product basket will fall another 5% in the fourth quarter because typically they hold inventories for 6 months. So the entire rubber prices are in fact down significantly, and crude derivatives have also fallen as supply has increased. So profitability will keep on improving. Demand is subdued, and but in these kind of industries, sometimes you have huge volume growth, but profits decline. So that doesn't create any wealth for shareholders. We need profitability growth. I think profit growth will be strong, and going forward, if the demand also revives, then that could be an added benefit. So we continue to hold Apollo Tyres.
Nuresh, what's your take on the entire tire space? Which are your top picks?
So in terms of tire space, one stock which has been looking interesting now after the correction is CEAT Limited. The stock saw a huge rally from 800, 900 levels to 1950 and has now corrected towards 1500 mark. The last breakout for the point saw the stock was around 1400, 1450. So now could be a time to slowly accumulate into CEAT Limited. That could be the interesting one. And apart from that, Apollo Tyres continues to be the leader in terms of price action. One of the stocks which is at a new all-time high. So the stock had made a top at 320, 300 levels back in 2018. And then the top was around 250 for 2021 to 22. So this has clearly set up a trend. So out here, the only problem is the stock has moved up quite a bit. But going forward, a dip to 300 to 310 zone would be a buying opportunity.
Takeaway then, Sandeep, when it comes to Cummins India, we did see the stock hit a 52-week high. There was a Q3 results playing out. Within this space, would something like a Cummins catch your eye, or do you have any other preferred bets? I know you are pretty bullish on L&T, but anything else that you'd look at?
I see all these capex-oriented companies are doing well. Some of them across various industries. So Cummins is doing very well. All its businesses are firing. The only issue which comes up in many of these companies like Siemens, Cummins, ABB, etc., is the way they have moved up and the valuations now. So the valuations are stretched. So investors need to wait for opportunities if there's an overall market correction or they weaken, and that will be the time to actually buy rather than buy after a straight line moves.
Okay, thanks very much, Sandeep, for joining in and sharing with us your outlook on the markets. And just gearing us ourselves for the pre-open rates this morning, and that's just trickling in on your screens right now. Absolutely flat for the Nifty right now with a mild negative bias, and ditto for the Sensex. But let's put the spotlight on Hindalco. It's been a muted quarter. The revenue has beat expectations, but margins were a miss. Let's hear out the management speaking about the growth prospects for the company.
Yeah, so first, I think the Hindalco India business of both aluminium and copper had a very good Q3. And in fact, was an improvement over Q2 because the Indian macroeconomic environment has been pretty good. Coal availability and pricing improved. So the India business in Q3 did better than Q2. And in fact, the bottom of the market for us in India was Q2. Novelis certainly had a bad quarter in Q3, affected by some of the macro and can destocking by some of our customers. And I think going forward, you're going to see the Novelis performance in Q4 improve as this destocking goes away. No, actually, we have been very pleasantly happy that the auto demand has been quite steady because I think, during the semiconductor chip shortage in the previous years, there has been a lot of pent-up demand for cars and SUVs. So from our side, we have been seeing record shipments to the auto sector. So I think that auto side demand looks to be quite steady. Yeah, I think fourth quarter, we are expecting to see a further 5% decline in the cost of production because besides coal, we are seeing some of the carbon-related furnace oil, all these pricing starting to flatten and go down. So our expectation is another 5% decrease in the cost of production Q4 to Q3. Yeah, I think the alumina, when you see the alumina EBITDA, it's what we sell in the third party. So alumina sales in Q3 was 150 KT versus 240 in Q2. So I don't think there was any margin issue. It was just that the volumes of alumina we sold in Q3 were less than Q2.
Naresh, just like you identified for our viewers, and I'm sure they benefited because of that, a stock like Indian Hotels, it went into multi-year of consolidation, and then it just popped right back up. Do you see that similar factor is at play in pharma now? 2 years of consolidation?
So in pharma, I would say it is a mixed bag across the board. So none of them have actually shown great strength, and the ones which have shown really not gone up in a big way. So I was very bullish on Sun Pharma. The stock has done well, but did not go up really fast. So the stock is the best performing pharma stock in the near term, but it has been a slow and steady ride. But then you look at what has happened to a DV's Labs or Aurobindo Pharma or a Gland Pharma. You can pick up a lot of stocks which have actually fallen 30-40% over the last couple of months or last 6 months. So it's a very difficult call taking a whole pharma bet, but one has to be stock specific. So something like a Lupin, which has gone through a very long phase of consolidation and a correction. So the stock was at 2,000 rupees back in 2015. The stock is at 700, 800 rupees today. That seems to be making a turnaround. So if I were to look at the charts, every chart in the pharma sector is very, very different. So one has to be very stock specific. So from the bottom of the pack, it could be Lupin, which could turn around. From the top of the pack, Sun Pharma continues to be the best bet.
Okay, Okay, let's find out mid-cap recommendations then going from our chartists, and what is it that they're flagging off this morning. Kunal, your top mid-cap call?
So it's a buy on Vector Foods, a stock which we had discussed, a few weeks back. It's moved up pretty well from 440 levels earlier to now 500 plus. Even at current levels, the stock is showing a classical sign of a breakout as well as a continuation of uptrend. So suggest a buy. Targets revised to 550. Stop loss at 475.
All right, watch out for Mrs. Bector. That's Kunal's top recommendation from the mid-caps. And Naresh, you?
So that would be a buy on IDFC First Bank. The stock is showing a relative resilience in the current correction. It has been around that 58 to 60 mark as a sign of sideways consolidation and not seen a sharp correction unlike other banks in the small cap space. So out here, eventually once it breaks out about 61, 62 levels, that would be a breakout. So on dips is a buy. The recent swing low of 55 becomes a stop loss and a target price of 70.
All right, there you have it. That's IDFC First Bank from Naresh. Moving right on then, Chris Wood, in his latest note of greed and fear, expects a recession in the second half of 2023, saying that he also has a 1% exposure back home to Bajaj Finance. Let's understand the key takeaways from this note, and we've got Pankaj here to walk us through those details. Morning, Pankaj.
Well, good morning. Let's first talk about the global thing on the Chris Wood greed and fear note, and he particularly points out that recession fears are something which definitely do exist. They believe that the CPI inflation in US will actually slow down, and the earnings that the street has is slightly elevated at about 1.8 times. Not giving a call on S&P, but saying that a lot of things to watch out for. As you pointed out, interesting changes. Bajaj Finance will be the one that they would look forward to. They have increased their weightage within the Asia pack by 1% and within the India pack by 1%. So there is a 2% increase on an overall basis. In Asia, HDFC Life has lost 1% within their portfolio and ICICI Lombard within the India portfolio. So they believe that once again it's time to go positive on names like Bajaj Finance, because that is something they believe will do well if policy rates were actually having a largely limited exposure now from here on, because they don't believe a lot of hikes would happen from here on, maybe one or two, not much, and that's why they believe Bajaj Finance is one of the best plays to play, and that's why upgrade in terms of a weightage that they have both in Asia and India portfolio. Bajaj Finance for the last 5 days has been doing well.
Okay, let's also tell you what else is happening.